Thanks very much, Tim. Nice to see you again, and thanks very much for having me this afternoon. What I thought I might do is spend a little bit of time giving a bit of background about who Alphinity Investment Management are and how we think about investing in equities and building portfolios, then spend a bit of time specifically on the global products that we manage here at Alphinity, and lastly, leave some time for Q&A if there's any questions from anyone. So if we move on to the first slide, Alphinity Investment Management were founded 13 years ago by the four principals of the business, who together have now worked with each other for nearly 20 years. We manage both Australian and global equity products. The business was launched with Australian equity funds, and 5 years later, the Global Core Fund was launched, and more recently, the Global Sustainable Fund. Now, today, the focus will be on the global products that we manage, that I'm part of. But if you would like any more information on Alphinity, the Australian products, or the global products, you can go to our website, which is alphinity.com.au. So if we turn to the next slide and talk a little bit about the global funds. We run two global funds which run the same process both as the Australian strategies, but also as the global and global sustainable strategies, and that is investing in earnings leadership. These are style agnostic funds. We can invest in value stocks, in growth stocks, in cyclicals, in defensives. They're concentrated and high conviction. Typically, we'll own between 25 and 40 stocks, but despite that, they are diversified across sector and across the world. They're managed by a team of 5, of which I am one of that team, with an average of 20 years experience in financial markets across each portfolio manager. The products themselves, as I mentioned, the core product and the sustainable product, the key difference being is that all stocks on the sustainable fund will have a net positive alignment to the UN Sustainability Development Goals. And one last thing to mention before we dive into talking a little bit more about how we think of building portfolios. These two funds were recently listed on the ASX as active ETFs. The tickers there are at the top of the screen, XALG for the core fund and XASG for the sustainable fund. These active ETFs, they mimic the global portfolios and they trade at NAV. So if we go to the next slide, we can talk a little bit about how we think about picking stocks and building portfolios. And this is a little bit of a religion here at Alphinity. It is how we think about investing, and it is core to the business and to the portfolios that we run for our clients. So effectively, what we believe in is earnings leadership. So we believe earnings drive share prices, and more specifically, we believe that earnings surprises drive outperformance. So what do I mean by that? I mean, if the collective analysts that are researching a company believe underestimating what the earnings potential is for that business, when that company reports and beats expectations, that is where you're able to outperform if you can be invested in those companies. So if you look at the chart in front of us, what you can see here is the grey line is the MSCI World looking back nearly 35 years. And if you've been invested through that period of time, you would have made about 7% per annum owning the index. If, however, you'd invested in the top quintile of companies that were the best positive earnings revision companies, so that is buying the best earnings revisions on the day that they report, so with very little foresight, then you would have been able to generate 10% per annum. If, however, you had perfect foresight and you'd bought those same companies 1 month before they surprised the market, then your annual return would be 17% per annum. At Alphinity, we strive to do the latter every day when we come into the office. If you tick to the next slide, please, Tim. So diving into what we mean by earnings and how we think about an earnings life cycle, here at Alphinity, we marry fundamental bottom-up research, stock research that all the portfolio managers conduct with robust proprietary quantitative inputs to pick stocks and build the best portfolios for our clients. So if you look at the chart on the right-hand side, this is how we think about earnings. And I want you to picture a clock. And if you're at midnight and you imagine a company at midnight, quite often everything is going well for the company. You cannot see any risks on the horizon. And at that point, usually collectively analysts are predicting that the good times will continue going into perpetuity. Similarly, if you're at 6 a.m., it's normally a company that's gone through an earnings down cycle. That might be 6 months, that might be multiple years. And typically at that point, analysts collective are predicting or forecasting earnings that continue to deteriorate, whereas green shoots may be just around the corner. And so what we try to do at Alphinity is we try to invest at 7 o'clock in the morning and we try to sell sometime before midnight. We think that if we're doing this consistently, it leads us to the best possible chance of success in picking portfolios. By avoiding investing before 6 o'clock, we avoid value traps. Similarly, by selling before midnight, we avoid growth traps. So if you tick to the next slide, we can talk about how this works in practice. So LVMH is a very high quality luxury goods company listed in France. It's one of our larger positions in the portfolio, and we purchased it in mid-2021. We bought it at the time that we thought the downgrade cycle post-COVID was over, and we're confident in the earnings upgrade cycle looking forward. To give you an idea of the quantum that we're talking about here, when we bought the stock, analysts were predicting that the company would earn earnings per share in 2022 of about $20 a share. We've just ticked, obviously, through to 2023 or now 4 or 5 months through, and we've gotten the results for 2022 for LVMH, and they actually ended up delivering $29 per share of net income. Analysts had underappreciated the robustness of the recovery in their earnings by nearly 30%. So you can see that if you're able to predict earnings ahead of where the consensus is, it leads to outperformance. Over the period that we've owned LVMH, the stock has outperformed the MSCI World by 50-odd%, and it's actually in doing so led to Bernard Arnault, the CEO and founder, to become the richest person in the world. So if you tick that over to the next one. I just wanted to come back to a point that I made at the very start, and it's very important to make it well known that we are style agnostic. We don't mind if we're buying cheap stocks. That might be banks, though we don't own any banks at the moment, and we don't mind owning growth stocks. That might be tech or med tech at any point in the cycle, as long as they're the earnings leaders. As I mentioned, we believe in earnings leadership, and we want to own the companies that are surprising on the upside consistently through the cycle. So we want to be able to perform whether growth is performing or value is performing, cyclicals or defensives. And this chart sort of shows that in practice. So the blue line is the MSCI value over the MSCI relative to the MSCI growth index. When the blue line is falling, growth is outperforming, and when the blue line is rising, value is outperforming. So you can see since the start of the funds, the global fund inception, we've had 3 different regimes where either value or growth has been the leader in that particular time. And the yellow line is Alphinity's relative performance over that period of time. We strive to deliver consistent returns regardless of the market regime. So if you tick through to the next slide, please. I'll try and go through these next couple of slides quite quickly. But what they are is they're designed to give you a little bit of an insight into the types of businesses we own and to the diversification across the portfolio, despite it being very high conviction and a low number of stocks. So slide 8 will show you our top 10 as of the 30th of April. Slide 9 shows you the diversification across sector and across revenues if you split out the revenues in the portfolio. So with that, I might, given timing, switch it back to you, Tim, if there's any questions.
Yeah, good timing, Chris. Can we just go back to that last slide, please, Abby? Just in terms of your sector exposure, there's no resource exposure there. Where are you positioned in that regard?
You have the little I don't know what you call it, green, aqua green slither there is materials. Materials is quite a different sector globally than it is here in Australia. Here in Australia, it's much more metals and mining. Globally, it's chemicals, it's steel, it's paper and packaging. It's a very different universe globally. And I should point out here, the global funds is global ex-Australia. So we don't own the Australian miners in the portfolio. We own one material stock, that's Freeport. We believe in copper. We believe in the longevity and sustainability of that cycle. But yeah, materials is quite a different sector globally than locally.
And if you do recognise those companies, and like the example you've shown, where you do have that earnings surprise and that momentum, how do you manage the position if you're getting close to 12 o'clock?
As conviction in the earnings cycle reduces, as the portfolio manager or the analyst on the stock loses conviction on where we are in the earnings cycle, we'll be trimming the stock. If a stock reports and it's against what we thought they were going to be, if it turns out that it's actually midnight earlier than what we thought, we'll be sellers.
And can you talk through the views on the debt ceiling? Obviously, from a macro perspective, what role does that play? And what are your views on the debt ceiling? That seems to be what the market's focused on at the moment.
Yeah, sure. I thought that this question might come up, but I'm not sure I can add too much to it. Look, we're macro aware, but ultimately we're bottom-up investors. We do the stock work, and as I said, we believe in earnings. The macro will impact earnings. You know, a good example is the banks. They're pretty much, earnings are driven by the macro in a lot of instances. But in the debt ceiling in particular, I'm not quite sure how many debt ceilings now I've worked through, but I remember the 2011 one quite specifically. But I don't have a view on the debt ceiling. I don't know whether it's going to be resolved before this video is sent out. I don't know if we're going to head into a shutdown of the US government. But we're aware of the risks, but because we can't add value around that, we're not necessarily changing positions in the portfolio.
Yeah, it seems like more a political football than anything else. And you must be on the plane all the time, given you've got a global portfolio. How often are you travelling?
Yeah, travel's it's a really big part of it. It's a perk and it's challenging. Zoom, like today, is a fantastic tool, and it is a tool in the toolkit that we'll use for a long time, always. It improves the communication with our companies, to be honest. But there is nothing like going on the road and sitting down with companies that we own, with their competitors, with potentially new investments. So travel's important. We're traveling regularly. We each do 3-4 trips a year, sort of a couple of week trips or a week at a time. I ran the numbers the other day. I think last year we did 300 company meetings offshore across 13 countries and 7 continents, I think. And in the next month, or the next 4 weeks, the whole team is out of the office at one point or another, visiting China, US, and Europe. I go on Sunday to Europe to visit industrials and energy companies. So I'll be going to France, Sweden, Denmark, and the UK. And to give you an example of what I'm doing there, a company that we own, we talked about materials, company that we own is Sandvik. It's listed in Stockholm in Sweden. It's about a $22 billion global leader of underground mining equipment. So I'm going to see them in Stockholm, and I'm spending a day with their competitor, Epiroc, to try and understand the opportunities in battery electric vehicles for mining, because Sandvik's the world leader in underground load and haul. So we're spending time on the road. It's challenging, but it is extremely worthwhile.
And Chris, just finally, how's the portfolio position today?
Yeah, I mean, I wouldn't shock anyone to say that the environment is very uncertain today. You know, as you said, we've got the debt ceiling hanging over. We've had unprecedented rate hikes. We've had mini banking crisis in the US. China's reopened, but that looks increasingly shaky. So the macro environment is very uncertain. But at the same time, equity markets are close to 12-month highs. I think Monday, the MSCI World touched a year-long high. So you've got a real tussle between quite a concerning macro environment and what the market is doing is quite different. And so if we strip it back and we focus on earnings, and that's what we do, you know, we can look at, I included in the pack, I'm not sure if you can go to slide 18, but if we look at what's happening in earnings, we look at something, one of the slides that we look at, or one of the indexes that we look at is the analyst breadth ratio. So this is the diffusion ratio, which is the number of analysts that are upgrading earnings versus downgrading earnings. And as you can see, this is the yellow line. Analysts have been slowly downgrading, or this has been falling, this index, for 18 months now. It's still been positive until sort of mid last year, and it's still negative today. But if you squint, you can see that it's not quite as bad as it was, say, 6 months ago. Now, you know, I'm not brave enough to say that that's a turn and something's changed, but we just had a reporting season across the world. Earnings were better than feared. They're still not necessarily robust, but they were better than feared. I mean, we had NVIDIA report last night or the night before and trade last night, and their earnings, their guidance for the second quarter is double what people thought. So there are companies out there that are beating expectations. And so, you know, bringing this back to the portfolio, we're very open-minded to what's going on in the world. We see on the earnings side, things are a little bit better than expected, but likewise, the macro is very unknown. So we are keeping our minds open to the possibility of positive and negative news. Specifically on the portfolio, we've added tech back recently, or we've increased our exposure to technology. We've added Microsoft and Alphabet. These are great global companies that we've owned in the past that dropped out of process, and now they're back in earnings upgrade cycle, and so we own those stocks again. On the flip side, we have sold some of our cyclicals that have done well. So we recently sold out of Mercedes-Benz, for example. And on the defensive side, we've trimmed some of the expensive defensives, but still retained some really high-quality defensive stocks in the portfolio.
Right, Chris, that's all we have time for. Thank you for your presentation, and we'll catch up shortly.
Thanks, Tim. Thanks, everyone.